net worth explode at 100K.
Growth really explodes. Get ready to explode your net worth. Explode your net worth. Explode your net worth.
It's not actually quite that easy, and in this video, I'll go over why $100,000 doesn't actually explode or skyrocket, and how some of the advice in these videos can actually land you in trouble. So what is special about the $100,000 net worth? It's really no big mystery, but the common theme is about investing and compound growth and compound interest, where the more money you have, the faster it can grow. And the numbers frequently touted are 7% average increase year over year, up to 10% average increase year over year. This is based off the S&P 500, which is an index that tracks the performance of the 500 largest publicly traded companies in the US. It's also a pretty good indicator of the overall market, which is why it's commonly used as a reference. 401k and retirement plans usually have options to invest into the S&P as well, and the 7% year-over-year gain is from 1957, from when the index was first created, to around 2017, and 10% is a more recent number from 1957 to present day. And theoretically, this works just the way they explain. If you plug in $100,000 as a starting value, and we assume 10% year-over-year increase with 0 monthly contributions, you'll have a bit over $250,000 in 10 years. So that's about $25,000 each year. In 20 years, you'll have almost $700,000. And around 25 years is when that will become a bit over $1 million. You take $1 million, you divide it by 25, you get $40,000 annually, which your day job will usually pay more than the return on investment. So whether you count that as skyrocketing or not, it still takes a pretty long time to get there and a good deal of patience. But these videos are simplistic viewpoints given to you in a simplistic format to fit a 10-minute video. The average increase year over year is just that. It's an average. The downturns can last years in a bad decade. So if you had planned on storing your money in investments, expecting to reach enough for retirement by age 65, or let's say have enough for a down payment on a home in 5 years, that can actually seriously mess up your plans if you expected your investment to simply increase every single year. In this case, timing actually matters a lot, so it's a bit of a gamble to estimate or forecast just how much cash or liquid assets you'll have on hand at the time when you actually need it. Number 2 is that it depends what makes up that $100,000. Because what if your $100,000 isn't in cash and you can't use it to invest that into the S&P 500? Let's say a horrible example where you own a supercar that's worth $100,000, then your net worth won't be going up, it'll just be going down. But now let's say a more realistic example, you own a home that makes up $100,000 of your net worth and your cash is tied up in that home. Depending on where it is, real estate may either appreciate a lot, may not appreciate at all, might even depreciate, but nationally, the average is usually between 3 to 5% increase year over year. So if we use that same calculator, let's assume $100,000 in initial investment, which is the house, and assume 5% interest rate. Then in 40 years, you'll have about $700,000 if everything goes well, and that annualizes to about $18,000. Now the reality is that most Americans have the majority of their net worth tied up in their home. So most Americans' net worth, realistically, they're gonna go up more around the average of 3 to 5% rather than the 7 to 10% of the S&P 500. Now the pitfall is, if you had assumed that $100,000 net worths, no matter what, goes up 7 to 10% each year, from what those videos say, you would have been overestimating your year-over-year growth, which can negatively affect your financial plans. And those are things like retirement, purchases, etc. Number 3 is your income versus expense equation. Building wealth at its simplest core is a very simple equation of how much money comes in and how much money goes out. So even if you have $100,000 net worth, whether it's from an inheritance, you won the lottery, you worked your way towards it, whatever it is, it's more about if you can sustain it or if you'll need to dig into it to pay your bills and expenses. Starting with the biggest expense for most people, if you own your home, then a significant part goes into home maintenance, property taxes, home insurance, etc. If you don't own your home, then you pay rent. And all of this is really expensive. And not everyone can live at home with their parents. So the key here is that it's not just about whether you have $100,000 net worth or not, but rather your income versus expense equation also factors in, and it's one that you should ideally be able to maintain and is what got you there. And I emphasize on it being something that you can maintain because as people get older, they have more expenses. They buy homes, they get married, they have children, they spend more because they make more. It's called lifestyle inflation. Or sometimes you get into an accident, you get sued, you get major health issues, or you once in a lifetime make a bad financial decision that costs you a lot. So a lot of these things can actually happen. So just because you manage to save up a lump sum at an early age, there's not a guarantee that these new milestones in life won't end up costing you more than you can afford. So the key point here is that $100,000 net worth doesn't necessarily just go up or just skyrocket. Depending on your cash needs, it can go down, but hopefully we do our best to drive it up higher. Number 4 is that YouTube is ultimately a business. At the end of the day, it's a business for most finance channels where people are hunting for more views to make more money. And most know that it's the catchy clickbaity titles with thumbnails of shock and surprise or full of emotion, with their mouths as open and as big as they can stretch them to be. And that goes for me too. I'd like to have more subscribers and more people watching my videos also. But I do draw the line at the fake thumbnail expressions, which is why you won't see any of mine have that, even if it does ultimately hurt my channel. So expect that the titles or thumbnails to be somewhat clickbaited, sensational, or designed to grab eyeballs. Some influencers are actively trying to con you out your money, but others do intend to help you while also helping themselves. Just remember that a lot of times there are often 2 or more sides to the story. And thanks for watching.